Hello everyone, welcome to another weekly video update. Now we're going to begin today by talking a little bit about what Powell mentioned in the Jackson Hole Symposium. And, basically his speech was pretty much of the same, a bit of a nothing burger if you ask me. Once again, the message is the same. It is the Fed's job to bring inflation down to our 2% goal. We'll do so, Mr. Powell said, comparing his speech to a stern set of remarks delivered at last year's Jackson Hole gathering. So basically, pretty much in line what we have been hearing so far, quite hawkish in terms of, saying that the Fed is data dependent and in fact, opening the door to yet another increase in interest rates. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down towards our objective. So a couple of things here. First of all, and in terms of the upcoming rate hikes, following the speech, even though the market did actually end up rallying quite strongly on the day, and we'll talk about the technical reasons behind that. We can see that actually there has been a notable change in the in the expectations going forward for the rate hike. So we now have close to about a 20% increase in possibility, 20% likelihood that the Fed will raise rates in the next meeting. And if we go out to November, you can see that there's at least a 46.7% likelihood that the rate will be at 550, 575. Okay, so this is implying that the market is looking at a rate hike either in September or at the very least in November as, kind of almost getting close to the most likely scenario, which is quite interesting. So Powell did mention that, conditions weren't very restrictive. And, he kind of does have a point. If we look, for example, here at the St. Louis Fed Financial Stress Index, we can see that financial conditions are still quite loose. And, they pretty much have been ever since, we can see, for example, here in the Kansas City Financial Stress Index, that this is more or less when we had that banking stress. Since that banking stress especially, and, the special loans that the Fed made, financial conditions have loosened. So it's not unreasonable to believe, and I've made this point before, that inflation is going to continue ticking up. I mean, we look, for example, here at this chart, comparing the Chicago Fed national financial conditions and the consumer price index for urban consumers, the CPI, right? We can see pretty much a very strong correlation, right? We can see that, as soon as financial conditions become tighter, right, we can see inflation coming down. And also the opposite, right? If inflation conditions become looser, then inflation comes up. And basically, what do we have here now? Well, we can see that financial conditions have become looser and inflation could basically remain a bit sticky, or as I've talked about before, sticky disinflation. Now, it's also interesting to see how, for example, the TIPS, right, the inflation adjusted bonds have been ticking up, and basically the market is kind of signaling that it is expecting more inflation, right? We can see this here in this chart, how we've kind of increased here in the last few months or weeks at least. And then also here, for example, you can see the curve for the US CPI. We have the curve as of the 11th of August in orange, and then as of the 24th of August. And we can see that it's actually, inflation expectations have pretty much basically come up a little bit in those last few weeks, which is definitely kind of interesting. And, well, again, kind of in line with what I've been saying for a while about, that kind of last tranche of inflation being a little bit stickier and harder to deal with, something that, no surprise, also Powell's also been talking about. And the idea that basically we're getting ready for yet another rate hike. So one more rate hike, even though we had paused previously. Now, another important takeaway here is how rates are affecting treasuries, and treasuries really have been on the move lately a lot, and basically kind of, we could say, behind a lot of the pain we've seen in the stock market, those kind of rates really creeping up. And, there's a few reasons we could find behind this. Obviously, higher inflation expectations could be one, higher growth expectations, but also the idea that the Federal Reserve is running out of buyers in the longer maturities, right? And this is actually something that, we can see here that US Treasuries have actually been talking with banks about, buyback programs. So the Treasury is already talking about starting to buy back bonds, towards 2024. We can see here that the Treasury noted that it may need to modestly increase the size of some of its coupon-bearing debt auction as soon as August, and asked banks which maturities they expect to see increase and how size increase should be managed across the Treasury curve. This is very interesting also when we have, for example, the fact that, the latest issuance has been flooded really pretty much on the short side using Treasury bills. And this raises the question, and well, I can't take credit, this isn't a question that I've raised, but I heard this on the Lead Lab report podcast of Michael Guyed, and one of his guests talks about the idea that, isn't the Fed to an extent already doing yield curve control, right? So we have this big control of how the supply has been dealt out. We're talking about Treasury, about bond buybacks starting next year. And basically, this is very clear signs of distress and, kind of the early innings, if you will, of yield curve control, right? Nothing like what we're seeing in Japan, but, getting close to that situation, right? The issue with Fed rate hikes, of course, is how it affects global liquidity. And we can see here in this chart by cross-border capital, how global liquidity has been trending down. Well, actually, if we look at world markets, we've been seeing somewhat of a resilience, although, more so in the US. If we look at world markets, they have been trending down recently, more with the global liquidity situation. But, the question is here, has global liquidity bottomed? And, my first instinct would be to say yes, because we are starting to see basically the end of that hiking cycle with the Fed. We are starting to see China, of course, kind of opening the tap for monetary policy. And it's definitely going to be interesting to see how markets react, right? Now, of course, traditionally, we see a very strong link between equity markets and global liquidity. But, we have seen somewhat of a divergence in the coming weeks. The question is, of course, whether the equity market will begin to catch up in a way and kind of sell off, which is my first instinct, kind of based on the technical analysis and the kind of situation that we're in. Because, the other thing about the rate hikes is that it's really going to start taking a toll, obviously on the real estate market. I kind of talked about the commercial real estate market in the last newsletter. And now, of course, but of course, we can also look at the residential real estate market and look, for example, at housing conditions. And we can see that, for example, affordability is very low in the housing market. We can see that here, MBA purchase application index, kind of reaching pretty low levels yet again. Okay, so people aren't wanting to buy homes right now. And this could actually create some kind of a squeeze, especially when we look at, for example, the revenue for Airbnbs, right? And, this is from a tweet that went viral a little while ago. And we can see here, now there's been some disputes around this, but, the idea remains true, right? That, if this does happen, how much we believe this kind of depends on the data, of course. Here we can see the percentage change in revenue per available listing from May 2022 to 2023. And basically we're seeing, these earnings in Airbnb's plummet, right? So basically the idea is that this could eventually create some kind of situation where you get a lot of sellers coming into the market, possibly from these Airbnbs, and then not enough buyers, right? And this is also something we can see in this divergence here. We have Airbnb inventory versus homes for sales. And we can see that the rentals on Airbnb have been climbing up while the listings for sales, right, down here, right? There's nearly 1 million rentals on Airbnb/VRBO, 65% higher than the 560,000 listed for sale on the US housing market. And now, of course, this could bring a lot of trouble to banks as well, right? Both on the commercial side and the residential side, right? And let's not forget that it was only back in March and May where we had that collapse of SVB Bank and that fast intervention by the Fed. Now, could something similar happen again? I wouldn't be surprised, right? I mean, the Federal Reserve is already talking about raising rates yet again. And, the same problems that, the banks were facing back in March, May haven't really been dealt with. And we are, in that regard, we do still find ourselves in that duration crisis, right? The idea that there's this mismatch between the duration of the bonds and the liabilities, and that could morph into a liquidity crisis. And this has also propped up some speculation, at least, if we were to take this a little bit further and maybe put on a little bit of a tinfoil hat on, we could ask ourselves, is there some kind of deliberate action here by the Federal Reserve to actually create a kind of turmoil in the banking industry to help with bringing around CBDCs. And, this argument is quite interesting, right? I mean, we have seen, of course, CBDCs, right? Central bank digital currencies are starting to come out in China. And, even though it is being downplayed, we have Fed Now, which came out, I believe, towards the end of July, kind of as a bridge to a digital dollar, right? We can see here in this report, Fed Now conveys money almost instantly versus the hours or data that's conveniently taken in the US. Finally, bringing the world's largest economy in line with other countries, the central bank has denied that Fed Now is tied to any digital US dollar initiative. But what is actually Fed Now, right? So the Federal Reserve officially opened its new instant payment service, Fed Now, on Thursday, significantly speeding up how long it takes to send money in the world's largest economy. The central bank said 35 banks and credit unions are participating. Early adopters include JP Chase. See some points made by Jerome Powell. The Federal Reserve built the Fed Now service to help make everyday payments over the coming years faster and more convenient. So Fed Now, even though it isn't a CBDC, it is basically a CBDC within banks, right? So right now we have those 16 banks, let's say, where basically, they have a direct connection to the Fed to be instantly paid, or, if the Fed so wished, I believe, basically instantly, their accounts could be instantly debited or credited. Basically, the next step would be to turn that into a CBDC where possibly, people could either have a bank account at one of these banks or a bank account directly at the Fed, where every transaction in the banking system is basically originating, or at least in some way going through the Federal Reserve. Now, isn't that basically a centralized digital, as in that it's, obviously not physical bank currency? I would say so. So we're definitely getting close to that. And point has been made that, CBDCs would be there would be some resistance to CBDCs, right? And a good way to implement them would be to create a situation where we might think, oh, we actually need something like a CBDC. So something like a banking collapse would basically make the public feel a bit more comfortable about moving to this CBDC system. Now, again, it's still kind of early to speculate, but it certainly makes a lot of sense. And, like I said, there's a lot of evidence right now pointing to the idea that, banking could be in trouble again, right? Now, let's talk a little bit about the outlook for the S&P and then look at some of our favorite charts as well. Now, first of all, I want to point out that, it is interesting to know that since 1928, September has been the worst month for the stock market on aggregate, right? We can see here 1 month S&P 500 returns since 1928. And basically, most of them are positive. The only negative ones we have are May, which is kind of almost 0%, February, and then September, which is, on aggregate, down a little bit over 1.5%, right? So very interesting to know that as we come into September, gonna open on Monday. That'll be then the 28th of August. Yeah, so we'll have a few days to, in my opinion, rally a little bit before we set up the next leg down. Now, looking at the next week, I thought it'd be interesting to point out that, if we look at the call to put ratio, which, I pointed out a couple of times before, we can see that there are a few more calls than puts right now for the SPX. So, that could lead to a little bit more downside, but, the difference isn't massive right now. So there's not a huge imbalance. So we could still see a little bit of rallying going on. And what you really want to get a big decline is that call ratio to get nice and high, So if we actually move on to our XPX chart, we can see basically our current Elliott wave count. And basically what I mentioned in my last newsletter was that, we were probably witnessing a diagonal, at least, or this would be the most bullish outlook, right? A ending diagonal where basically each one of the waves is actually a 3-wave move, right? So we have here wave 1, which is made up of an ABC. We have an ABC here for a wave 2. This was our completed wave 3 up here. And the way I see it, this is now looking to be an ABC wave down in 4. Now, the interesting thing is that, in this kind of diagonal, we can expect the wave 4 to cross over the wave one, which is about 4,000. Now, this isn't necessarily going to happen. It's not a prerequisite of this structure, but it's something that we could witness, right? The first levels that I would look at, though, would be, of course, the 38.2% retracement that comes at 42.84, and then the 50% retracement at 41.87. And now, of course, it's very important to note that this level here is very key. Of course, we have the 200-day moving average moving in here and the bottom of our trend line channel. So definitely a very important level there. Also, we can see important area of volume as well right there. Look at that, at about 41.25. We have, of course, all that trade that we saw. So it's definitely going to be a very interesting level, but it is ultimately a level that I'm looking for the SPX to test. So, that is, possibly getting close to a 5-7% decline. And we've already seen a substantial 5-7% decline. Of course, before that, my primary expectation is that we will head a little bit higher in the coming weeks. Now, I did outline this right here as my area where I would consider yet another short. Okay. And of course, that's, again, kind of based on a couple of factors here. Obviously, we have the 50% retracement coming in at about 44, so 44, 4,500. Interesting area to short. Interesting to note also that we did get rejected at the 50-day MA right there. And now we are getting kind of close to oversold on the daily chart. So I would like to see this head a little bit further up and maybe even give us, a little bit more of a divergence, right? So I'd like to see the price, make a slightly higher high with the RSI struggling to get up there before we set up for that final low in SPX. Of course, the NASDAQ is in a pretty similar situation. And yet again, I did mention this level to short up here, right? And, we didn't quite reach it, but, it's close enough, I think, where, at this point, we could definitely consider heading down into these levels. And, what's interesting with the NASDAQ is that we do have our trend line here. Support comes in a little bit sooner, right? So we have this trend line here would be coming in just about now, really coming in at about 14,580. But of course, below that, that's still well above our target for this retracement, right? So we do have measured out here the length of our wave three, this rally we see here. And the 61.8%, sorry, 38.2 takes us down to at least 14,186. And then the 50% takes us down to 13,000. And of course, that 200-day MA coming in at 13,110. So, still expecting reasonable drawdown. And, there has been a lot of talk lately with what's been happening in China and Japan about a possible credit event. We still have seen that unwinding in the Japanese yen. And of course, the yuan struggling, while the dollar, of course, gets stronger, which is not great for risk assets. So, could we basically see that kind of quote unquote credit event that takes us down here? I mean, it's interesting, right? You'd expect such a situation to really, take us a lot further down. So, if we did have a credit event, could it possibly take us down here? I mean, this would still be, a reasonable drawdown, right? So we'd be looking at, let's have a look here. Something close to, if we got to my short-term target and then maybe went down here, we'd be looking at a 50% drawdown. I think that's enough for, someone to say, oh, wow, something happened here. I don't think necessarily, right, that we need to make new lows. I believe that, we can have this kind of credit scare and, still maintain this bullish structure. But of course, we have to consider the possibility that we could head to lower lows. But I would have to start looking at that if we broke below that 200-day moving average, of course. So, I mean, in terms of the larger structure, like I said, this retracement is a little bit too big to talk about, further lows. And, it'd be quite tricky to point this out as the end of the wave five, because of course we haven't yet surpassed the prior high. So, as long as that level down here doesn't break, I still maintain that we're in for a significant correction, but not anywhere close to new lows. And to this regard, tech probably going to be one of the most affected, and I wanted to also really quickly go through the chart of NVIDIA because, of course, NVIDIA has been one of the stocks pulling up the SPX, but I do think that really, we look at the chart right here, and it is getting ready to fall. And again, something that I also saw pointed out in the Michael Guide podcast, where he mentioned that it is often the winners that investors cut out first, right? So if there is a situation where people are wanting to raise a little bit of cash, something like NVIDIA is probably going to be the first place that investors look to cut, right? And of course, in this regard, we can see that we have a clear divergence, obviously, on the weekly chart. Also, getting very, obviously we were very overbought, and now after this rally, still overbought on NVIDIA. And like I said, we don't have a lot of support coming in until, in terms of volume, until about 281, which is about the 50% retracement, yes, somewhere around this area. And this is also where the 50-day MA. So there's definitely for NVIDIA a level that I'd like to see retested. So again, for NVIDIA, looking at a 40% drop, I do expect the markets to hold up a little bit better. But I mean, obviously the index is made up of these stocks. So we're looking at some of these stocks ready to drop 30-40%. We have to begin to get a little bit worried with the Nasdaq. And now, although I'm a bit more bearish on stocks, I am still remain quite bullish on the outlook for oil and some of the other commodities, especially long term. I basically see us as probably setting up for reasonably higher highs, right? So while some of the stocks in terms of the Elliott wave have already got most of the meat out of, for example, their wave threes, I think that something like US oil right here is now just setting up to take us to new highs in that wave three. And so far this chart has played out pretty well. I mean, we called this top reasonably well, actually exiting those positions in some of our oil companies at around this level. And since then, we've come back to retest, obviously, the bottom of this trend line. And arguably, this could be, if we're in a very bullish market, this could be all the retracement. I would expect, however, a little bit further. And again, if we do get something like a credit event, you would basically expect everything to kind of go down together, really, especially in that kind of situation. So I do think again that we have a similar setup here where we see a little bit of a rebound. And September could be a pretty bad month for everything, really. Got to get into those T-bills. Basically, we'd want to, let's get rid of this. So basically, we'd be looking at maybe testing that 50% retracement. So, again, I'd be a big buyer here at 67, and I think a lot of the, especially a lot of the oil companies are very, very interesting. They have a very good financial position, and they'll definitely do very well once we get this rally going. Now, if we look at the gold chart, I'm kind of looking at something similar. Gold did give us lower lows in that wave C, and we have rebounded just above a 38.2% retracement here. Again, on the daily chart, basically we touched the oversold and bounced, and we also kind of bounced over that 200-day MA, but we're sort of creeping back below it now. And if we look, for example, at the weekly chart, we can see that we could still have a little bit further to go. I'd love to see gold get into this situation again where we get oversold on the weekly. We can see that really sparked a rally down here. I mean, it has historically really helped spark good rallies, right? And even back 2019, of course, very oversold on the weekly. That's where we got that big rally. Even down here, we were getting a lot closer to oversold on the weekly. So again, big buyer of gold if we can, retest these levels, right? On the weekly, we have the 200 week MA coming in about 170. So again, this right here, big good area to buy some gold, and of course silver. So silver actually also rebounding quite nicely here on the weekly chart, and we actually had a bullish crossover here of the 50-day MA over the 200. So, it's interesting. Silver, I think looks here a bit better, possibly with that bottom having been struck as we touch the top of this trend line. So, definitely would be interesting to see, if we zoom in a little bit on the chart and, if we get a little bit of a retracement in the coming days, that looks more corrective. Definitely. I mean, I already gained some exposure to silver as we were getting down here. And, we did leave some room for lower. Over here again, we just retested those levels. In fact, we didn't even kind of go lower than that. So, I think there's still some room for a further retracement, but again, this is looking a lot more bullish in silver. So, but of course, ultimately, everything's kind of going to revolve around the dollar and how rates move, right? And I've talked about this a few times before, and you can't see these risk assets really take off until until the dollar eases a little bit. And in terms of that, now I do basically expect the dollar to continue rising to about here, right? So I'm looking pretty much at this 108 level to be tested, right? So, based on our current outlook here, we can see that basically I still think that we're in this kind of an ABC situation where ultimately this C lands us with the DXY close to 94, 93, but before that, I think we could arguably make a higher high here in a wave B. Of course, again, momentum is pretty much to the upside here, right? We really sliced through the 50 and 200-day MAs. We sliced through this downward channel, and we really just have to deal with this resistance level up here. Of course, the DXY getting very overbought as well on the daily, not so much on the weekly, of course, right? So again, it would be very great to see basically the DXY, approach these levels, maybe even give us some divergence like we saw back here, right? Which sparked, our rally, when we began falling around here in October. So again, would be great to see a similar setup arise, and I think that could happen around those levels, right? So if we look here and at this initial move down, we'd be looking at something like a 50% retracement, gets to about 107, and of course the ever important 61.8% retracement, about 109. So again, you'd expect equities to fall. If we see this move in the DXY, you would expect equities and even Bitcoin to continue their downward trend. And again, with the latest move in Bitcoin, and this will be the last chart that we look at, I'm also pretty much expecting further downside. Now, again, I will say this is not the place to sell, right? Especially after this sell-off. But on a bounce, we could consider selling a little bit. Again, the setup we had before, which was this 1-2, right, where this is 1 and this is 2, it's not broken yet, but it pretty much is, to the extent that we have this retracement going back over the 78.6%. This is traditionally not great, okay, and also we haven't really seen the kind of reaction we'd expect. If this was a sell-off like back here, right, whereas a V-shaped recovery, this isn't looking good at all for Bitcoin right here. So again, basically looking for a much deeper retracement back down to about 20K. So if this is our initial impulse of the lows, 61.8% retracement gets us to 23. Also have a lot of volume coming in there, right around here. And of course, this is very much in line with the assessment, the kind of the traditional halving cycle, where we see that sell-off ahead of the halving and then that big rally basically as we break into the halving. Remember the halving is around March, April. So, interesting, could we see stocks, Bitcoin, basically September, October, November struggling, December, January, February start to take off, and then April, March, really take us to complete those all-time highs that we've been looking for. That would be the timeline that I'm looking at right now. And we'll have to see what happens until then. So that's all for the weekend update, guys. I hope you enjoyed it. And as always, we'll be back with in-depth newsletter on Wednesday. And, stay tuned for the updates. In the meantime, thanks for listening and have a good weekend.